Welcome to Wall Street Weekly. So, on Friday morning, before the opening bell even rang, Wall Street was literally minutes away from a catastrophic multi-billion-dollar death spiral.
Yeah, a massive, highly leveraged AI hedge fund was just, well, they were facing total liquidation.
Right. And if that portfolio had actually hit the open market, I mean, it would have triggered a contagion event, wiping out trillions in broader market value.
But you didn't see it happen. There were no breaking news banners on CNBC about a crash.
Exactly. Because behind closed doors, in just a few frantic hours, one billionaire stepped in to swallow the toxic assets whole, entirely off exchange.
It's wild to even think about.
It really is. So today, we are taking a deep dive into the week the market almost broke. We're untangling the sheer whiplash of the trading week of July 27th to July 31st, 2026.
And this is really the defining tug-of-war of our current economic reality, right? The crushing gravity of high interest rates doing battle against the, rocket ship momentum of artificial intelligence.
Which force is actually winning? That's what we want to answer for you today. By the end of this deep dive, you're going to understand exactly how the puzzle pieces of stocks, bonds, global commodities, and hidden leverage are colliding right now.
And more importantly, what this complex machinery means for your own portfolio strategy as we cross into August.
Yeah, absolutely. But to genuinely understand how a single hedge fund margin call almost broke the market on Friday, we have to start with the pressure cooker that created the crisis.
It's a macroeconomic bedrock.
Exactly. Specifically, the data released on Thursday and the profoundly difficult corner the Federal Reserve has been painted into.
Yeah, the foundational problem, the macro pressure cooker here, is that the U.S. economy is flashing two wildly contradictory signals right now. On Thursday, the BEA released its initial estimate for Q2 gross domestic product, and the annualized growth rate came in at a deeply uncomfortable 1.5%.
Which, I mean, in the context of a post-pandemic economy, it's essentially stall speed. When you dig into the components of that GDP print, it's not just some statistical anomaly, private domestic investment is contracting.
Yeah, and real consumer spending on discretionary goods is visibly rolling over. The underlying engine of the economy is it's losing its thrust.
Right, and if that 1.5% GDP print existed in a vacuum, the Fed's mandate would be super obvious, wouldn't it?
Oh, completely. They would cut interest rates immediately, inject liquidity, and stimulate borrowing to get that growth engine firing again.
But it doesn't exist in a vacuum. It exists alongside the June core PCE index, which is the Fed's preferred gauge for measuring baseline inflation.
Because it strips out the highly volatile daily swings of food and energy costs, right?
Yeah.
To show the real underlying trend.
Exactly. And that core PCE is stuck. Just stubbornly, immovably stuck at 3.3% year over year.
And their target is 2%. So they're still missing by a massive margin.
Yeah. I was thinking about the mechanics of this, and the standard analogies just don't capture the danger for you as an investor.
You mean the bicycle analogy?
Right. The one where the economy is a kid on a bike slowing down and inflation is a heavy backpack.
Yeah, that one.
People say the Fed can't push the kid without making them crash, but that implies, a slow, clumsy failure. The reality of stagflation, this exact combo of 1.5% growth and 3.3% inflation, is way more violent.
It really is. It's like driving a heavy vehicle on a sheet of black ice while the engine is simultaneously overheating.
Yes, that is exactly the mechanical reality of this policy trap. If the Fed hits the brakes, meaning they hike rates to cool the inflation,
the wheels lock up on the ice.
Exactly, and the 1.5% growth spins out into a devastating recession. But if they hit the gas pedal to stimulate growth,
they blow the engine, they reignite the inflation fires, consumers lose their purchasing power, and you risk a 1970s-style unmooring of inflation expectations.
Right. And that black ice scenario was exactly the dilemma facing the FOMC on Wednesday when they had to determine the baseline cost of capital for the whole global economy.
And the committee, led by Chair Kevin Warsh, ultimately voted to hold the federal funds rate steady at 3.50 to 3.75%.
They basically chose to do nothing, just took their foot off the gas and the brake and decided to let the car glide on the ice and pray the engine cools down.
But the vote wasn't unanimous. And, in a committee that prides itself on a unified front, dissents are incredibly rare.
Yeah, this vote was 9-3. Three officials, Beth Hammack, Neil Kashkari, and Lori Logan, broke ranks.
And they didn't break ranks because they wanted to cut rates to help the economy. They actually wanted a rate hike.
They wanted to slam on the brakes.
Which tells you just how terrified certain factions of the central bank are about the stickiness of that inflation.
Right. They are looking past the headline data and focusing heavily on the transmission mechanisms of energy-driven inflation.
Yeah, we're going to dive into the Middle East situation in a bit, but their core thesis is that when crude oil spikes, that cost is universally contagious.
Exactly. When maritime shipping firms and long-haul trucking fleets pay more for diesel, they don't just absorb those losses.
No, they pass them directly onto the final cost of every physical good and service. The dissenters are arguing that 3.75% simply isn't restrictive enough to crush that kind of structural inflation.
But I mean, the human cost of holding rates at 3.75%, let alone hiking them, is becoming impossible to ignore.
Oh, absolutely.
For you, the listener, navigating this economy, this isn't just abstract monetary theory. You can see the damage in the data. The Conference Board's Consumer Confidence Index dropped precipitously this week to 90.8.
That 90.8 reading is a glaring klaxon horn for the domestic economy. I mean, consumer spending accounts for roughly 70% of U.S. GDP.
Wow.
Yeah. When confidence shatters, the structural foundation of corporate earnings begins to crack.
And we are seeing a massive bifurcation in how households are experiencing this. If you are a high-income earner who locked in a 3% fixed-rate mortgage back in 2021 and you own a bunch of tech stocks, you are largely insulated.
Right. But for the middle and lower income quartiles, the vice is tightening from both sides.
Squeezed at the grocery store by the 3.3% inflation, and squeezed by the credit markets because of the tight monetary policy.
The credit card data corroborates this perfectly. Average APRs on revolving consumer credit are near record highs, well north of 22%.
It's brutal. Auto loan rejections are spiking too. The Conference Board data specifically highlights a massive shift in behavioral economics this summer.
Yeah, like the surge in staycations. Families are completely pricing themselves out of domestic air travel.
And the replacement cycle for major appliances is stretching from 7 years to 10 years. Consumers are delaying capital expenditures because financing them right now is just structurally prohibitive.
It is a double whammy of historic proportions. The consumer is exhausted.
And that exhaustion, the realization that the Fed was perfectly willing to leave the economy on the ice without a lifeline, is exactly what triggered the absolute bloodbath on Wall Street on Wednesday afternoon.
Wednesday was a masterclass in market capitulation. When Chairman Warsh explicitly stated they need, quote-unquote, substantially more evidence that inflation is moving to 2%, the algorithmic trading desks just triggered a cascade of sell orders.
Because the market had been aggressively pricing in a high probability of a rate cut?
Exactly, and Warsh completely shattered that assumption.
The numbers were staggering. The Dow collapsed by 11,153 points in a single session.
A 2.19% drop.
Yeah. The Nasdaq shed 1.74%, and the S&P 500 fell 1.52%. You had these massive quantitative funds, CTAs, rapidly flipping their positioning from long to short.
And the bond market reacted with equal violence. The 10-year Treasury yield surged to 4.68% by Wednesday's close.
Because fixed income managers finally capitulated to the higher for longer reality.
Right. And when the risk-free rate of return spikes that aggressively, it instantly compresses the valuation multiples of every single equity in the stock market.
And this is where the narrative of the week completely fractures. If you just look at the weekly closing data on Friday afternoon, you'd have no idea Wednesday's panic even happened.
It's crazy. The S&P 500 finished the week up 1.03%. The Nasdaq finished up 1.77%.
So if the macro environment is so toxic and the consumer is suffocating, how on earth did the major indices pull off a miraculous rescue?
The answer lies entirely in the microeconomics of the AI revolution. The broader economy might be stalling at 1.5% growth, but on Thursday and Friday, the titans of the cloud computing sector proved they are in an entirely different stratosphere.
Because Microsoft released their Q2 earnings, right? And the absolute centerpiece was this breathtaking 43% year-over-year surge in Azure cloud revenue.
A 43% growth rate on a revenue base of that magnitude is almost difficult to comprehend. It added hundreds of billions to Microsoft's market cap virtually overnight.
Sent the stock spiking 15.5%.
And Amazon followed suit just hours later. They reported Q2 profits that more than tripled Wall Street's consensus estimates.
Driven almost exclusively by AWS, their cloud division, Amazon's equity leapt 15.3%.
What is critical to understand here is why the market reacted with such ferocious buying pressure. For the past 18 months, there's been this deep existential dread about the massive capital expenditures big tech has been deploying.
Right, tens of billions poured into semiconductors, data centers, power grids. There was this pervasive fear that we were reliving the late 90s dot-com bubble.
Exactly. The fear was they were laying down a massive network of fiber optic cables to nowhere.
Building incomprehensibly expensive AI infrastructure only to discover enterprise clients actually had no practical use for it.
Which would have led to a catastrophic collapse in return on invested capital. But the Microsoft and Amazon reports decisively vaporized that fear.
They proved the AI transition is no longer a speculative science project. It has moved to the monetization phase.
Yes. The 43% surge in Azure indicates that Fortune 500 clients are actively migrating their workloads to generative AI models.
And most importantly, they're paying premium subscription rates for it. Microsoft and Amazon proved the AI rocket ship is generating real accelerating cash flow.
Enough cash flow to essentially pull the entire S&P 500 out of its macroeconomic nosedive.
But, that immunity shield only extends so far. When you look at Apple's performance this week, the contrast is glaring.
Apple plunged 9.1% on Friday. They completely missed the relief rally.
It perfectly highlights the difference between software scalability and hardware vulnerability, doesn't it?
It is a critical distinction. Microsoft and Amazon are fundamentally selling digital infrastructure and compute power. Once the server is racked and powered, scaling the software distribution is virtually frictionless.
Right, but Apple, despite its massive services segment, is still overwhelmingly tethered to physical hardware manufacturing.
They missed their forward revenue guidance, not because consumers don't want the new iPhone, but because of severe supply chain bottlenecks.
They're highly exposed to physical logistics, TSMC fabrication yields, and international trade friction. I mean, you can't distribute a titanium chassis over the cloud.
No, you cannot. When global supply chains constrict, hardware companies suffer margin compression instantly.
Which serves as a perfect transition into the most severe divergence we saw in the equity markets this week. Because while the tech-heavy S&P and Nasdaq posted substantial gains, the Russell 2000,
The benchmark for small-cap companies.
right, it went in the exact opposite direction. The Russell 2000 actually fell by 0.57% for the week.
And this isn't just a slight underperformance. This divergence is the defining structural reality of the 2026 market.
If you want to understand why the S&P is thriving while the Russell is drowning, you have to look at the architecture of corporate debt.
The Microsofts and Amazons are insulated from the Fed's 3.75% interest rates because they are cash-rich. They are sitting on literal mountains of liquidity.
So when the Fed holds rates high, it actually benefits them because they're earning a massive risk-free yield on their short-term treasury bills.
The high cost of capital doesn't hurt them. It pays them. But the companies in the Russell 2000 operate in a completely different universe.
These are your regional logistics firms, mid-sized healthcare providers, domestic manufacturers. They don't have massive cash reserves.
No, they rely intensely on corporate credit markets to fund payrolls, maintain inventories, finance capital equipment.
And the fatal flaw is that a massive percentage of their debt is floating rate debt.
Which means they are directly tethered to the Secured Overnight Financing Rate, or SOFR.
As the Fed keeps rates elevated, the interest expense on these small-cap loans remains excruciatingly high.
Right. If you're a mid-sized manufacturing company with a 10% profit margin and your interest expense suddenly doubles because your loan resets,
Your net income is entirely wiped out.
it is a slow, structural suffocation. Every single month, the FOMC holds rates steady. They're actively crushing the profit margins of the domestic small-cap sector.
And small-cap investors saw that hawkish Wednesday press conference, realized no relief was coming, and just liquidated.
So you have a market that is deeply historically fractured. Megacaps generating unprecedented cash flow, while American small business hits a massive wall of unmanageable debt.
Which brings us to the most terrifying part of this entire deep dive. Because that exact issue, the lethal combo of high borrowing costs and sudden volatility, almost caused a systemic market failure on Friday morning.
The hidden contagion.
Exactly. I was reading through the transcripts of this, and it is genuinely chilling. We mentioned earlier that Citadel stepped in to rescue the market. Let's unpack what actually happened with the hedge fund's situational awareness.
So the fund, managed by an investor named Aschenbrenner, was running an incredibly concentrated portfolio, heavily tilted towards semiconductor manufacturers and AI infrastructure.
But the critical issue wasn't the stock selection, right? It was their leverage.
Yes. Situational awareness was utilizing institutional leverage, reported to be as high as 400%.
To put that in context, this isn't retail margin trading. They had negotiated with their prime brokers to extend their credit limits right to the absolute precipice of their value at risk, or VAR, thresholds.
For every $1 billion of actual equity, they were borrowing $4 billion to amplify their market exposure.
When the trade goes your way, that generates astronomical returns. But leverage is highly symmetrical.
When the underlying assets drop, the math violently turns against you. Prime brokers monitor the realized volatility of collateral in real time.
So on Wednesday, when the Dow dropped 1,153 points, semiconductor stocks got hit exceptionally hard.
The value of the collateral holding up their entire $5 billion portfolio just plummeted. Their risk models instantly breached the prime broker's VAR limits,
Triggering automatic margin calls. The banks essentially picked up the phone and demanded hundreds of millions of dollars in cash immediately to cover the widening hole.
but the fund was illiquid. They did not have the cash on hand to satisfy the margin calls.
Now, under the standard ISDA master agreements, if a fund fails to meet a margin call, the prime broker is legally authorized to step in.
They seize control of the portfolio and forcefully liquidate the assets to recoup their loaned capital.
An involuntary, price-agnostic fire sale.
Exactly. If those prime brokers had pressed the button on Friday morning, they would have dumped billions of dollars of semiconductor stocks onto the lit exchanges simultaneously.
And I really want to emphasize what that actually means for the plumbing of the stock market. If a multi-billion-dollar block of forced sell orders hits the national best bid and offer, it instantly overwhelms all available liquidity.
The algorithms see the massive imbalance, market makers widen their spreads, pull their bids, and the price of those stocks goes into freefall.
But it wouldn't stop there.
No, it becomes a contagion. If semiconductor prices crash because of this fire sale, the value of the collateral at other hedge funds immediately drops,
Which triggers margin calls at those funds.
forcing them to sell, which drives the price down further, triggering more margin calls. It is a mathematical death spiral.
Wall Street was staring down the barrel of a systemic panic, eerily reminiscent of the Argo's collapse.
Where hidden leverage almost broke the global banking sector.
But the death spiral never triggered, because Ken Griffin and the team at Citadel intervened. And not out of the goodness of their hearts, obviously.
Oh no. They did it because they saw a massive arbitrage opportunity. Citadel executed a single block distressed trade.
This is the crucial mechanical detail. Citadel did not buy these shares on the New York Stock Exchange or the Nasdaq.
They bypassed the lit exchanges completely. They negotiated directly with the prime brokers in a dark pool to absorb the entirety of the portfolio in one massive private transaction.
Swallow the toxic asset whole behind closed doors so the public market would never see the order flow.
And because they were acting as the lender of last resort, providing emergency liquidity, Citadel negotiated a severe discount on the assets.
They bought the bottom of the dip in a private room.
Yep. By intercepting that order flow off exchange, they surgically removed the threat of forced selling pressure from the public market.
And once the short sellers realized on Friday morning that the massive liquidation was canceled, they panicked.
They had to aggressively buy back shares to cover their short positions, which poured rocket fuel on the tech earnings rally.
Sending the Nasdaq surging 1.77% by the end of the week. It is genuinely sobering to realize that the structural integrity of the public equity markets on Friday relied entirely on a billionaire deciding that a distressed block trade was favorable enough to deploy capital.
It contained the contagion, but it proved how fragile the underlying market architecture actually is.
Totally. And while Wall Street was hyper-focused on this hidden leverage crisis and cloud computing margins, the international commodity markets were dealing with a massive crisis of their own.
The global tremors emanating from the Middle East.
Right, which circled directly back to the exact geopolitical fears that caused the Fed to hold rates steady in the first place.
The crude oil market experienced violent, erratic price swings, driven entirely by the shifting probability of geopolitical escalation.
If we track the international benchmark, ICE Brent crude, the week opened on a deeply optimistic note. On Monday, Brent crude futures actually dropped 6%.
There were highly credible reports circulating regarding a potential U.S. and Iranian brokered ceasefire.
So the speculative geopolitical risk premium, that extra cost per barrel to hedge against supply disruption, rapidly dissipated from the futures curve.
But that optimism collapsed within 48 hours. By Wednesday, the ceasefire negotiations had demonstrably failed.
Hostilities resumed with increased intensity, and by Thursday, the conflict had geographically expanded into Iraqi territory, necessitating new defensive airstrikes.
The commodity markets reacted with textbook panic. Brent crude surged 7.3% during Wednesday's trading session alone.
Instantly obliterating Monday's decline. It ultimately settled the week up 2.4%, closing at $87.93 a barrel.
And the futures curve shifted into steep backwardation.
Meaning the spot price for immediate delivery is significantly higher than the price for delivery 6 months from now.
Right. That structure indicates severe, immediate panic among commercial oil buyers who are terrified that the Strait of Hormuz could be obstructed.
Which is the vital maritime choke point for roughly 20% of global oil consumption.
And this brings us to the core transmission mechanism of why oil at $87.93 a barrel utterly terrifies the Federal Reserve. Energy demand is fundamentally inelastic in the short term.
You cannot simply start fueling maritime container ships, long-haul freight networks, or agricultural combines.
Exactly. The Fed's primary weapon against inflation is demand destruction. They raise rates to make borrowing expensive, which discourages spending.
But the Fed's interest rate tool is entirely impotent against supply-side commodity shocks. I mean, Jerome Powell and Kevin Warsh cannot drill new oil wells in Texas, and they certainly cannot mandate a ceasefire in the Middle East.
Which means they are structurally trapped. When energy costs surge, the cost of manufacturing and distributing goods spikes universally.
And those elevated logistical costs inevitably bleed into the prices of retail goods and core services.
The Fed's nightmare scenario is that they hold rates at a suffocating 3.75%. They crush domestic GDP growth down to 1.5%.
Triggering a localized recession?
And yet, because of a geopolitical conflict entirely outside of their jurisdiction, headline inflation still accelerates back above 4%.
That is the ultimate macro trap. It's the black ice scenario we discussed earlier, amplified by external variables.
It's a mess.
Yeah. And speaking of external variables, I want to pivot to a fascinating contradiction regarding the future of artificial intelligence that played out globally this week. We've established that Microsoft and Amazon proved AI is generating robust revenue domestically.
But on Tuesday, Fitch Ratings issued a highly controversial, sweeping global credit warning.
Right, Fitch, one of the 3 major rating agencies, and their analysis was stark, and it focused entirely on the debt markets, not the equity markets.
They directly compared the current velocity of corporate bond issuance funding AI data center construction to the catastrophic telecommunications fiber optic build-out of the late 90s dot-com bubble.
They pointed out that investment-grade corporate bond issuance surged 26% in the first half of the year. Tech giants and massive utility companies are issuing billions in debt to secure real estate, cooling infrastructure, and electrical grid capacity.
Fitch's thesis is that the market is structurally overbuilding. They're warning that if the adoption curve for enterprise AI software plateaus even slightly, these infrastructure companies are going to be stranded with massive debt.
And severely underutilized data centers, leading to a wave of corporate defaults.
It is a mathematically sound risk assessment based on historical precedent. However, the reality of physical supply and demand in the Asian markets completely contradicted Fitch's bearish warning on Friday.
It didn't just contradict it, it blew it out of the water. Friday's trading session in Asia was genuinely historic. South Korea's benchmark equities index, the Kospi, exploded upward, surging 17.9% in a single day.
For a diversified major sovereign index to move nearly 18% in one session is a Six Sigma statistical anomaly. It just doesn't happen.
And that historic surge was heavily concentrated in the performance of 2 specific corporations, Samsung Electronics and SK Hynix. Both of those individual stocks skyrocketed over 26%.
The mechanics of why this happened are fascinating. To understand the Kospi surge, you have to understand the physical bottlenecks of AI.
Right. Everyone knows about NVIDIA's GPUs, the brains of the AI models. But a brain is useless if it can't access memory fast enough. To train a massive large language model, you need high bandwidth memory chips, or HBM.
These are not standard memory chips. HBM involves physically stacking multiple DRAM chips vertically and connecting them with microscopic wires called through-silicon vias.
It's an incredibly difficult, low-yield manufacturing process, and SK Hynix and Samsung currently operate a near monopoly on global HBM production.
So when Amazon and Microsoft reported their massive cloud growth, the Asian institutional investors realized that the demand for these specific HBM chips is going to far outstrip global fabrication capacity for years to come.
The Kospi explosion perfectly encapsulates the trillion-dollar debate currently fracturing the market. Are we building a debt-fueled infrastructure bubble like Fitch warns? Or are we at the foundational stages of the most lucrative capital expenditure supercycle in modern economic history?
The market is violently trying to price in both realities simultaneously. And that cognitive dissonance is generating fascinating contradictory signals in the underlying metrics of market risk.
Yeah, if you look at the volatility indices this week, you see a massive structural divergence between the behavior of equity investors and the behavior of bond investors.
Let's break down the mechanics of these fear gauges. On the equity side, we have the VIX, which tracks the implied volatility of S&P 500 options. Essentially, it measures how aggressively stock investors are buying put options to ensure their portfolios against a crash.
On the fixed income side, we have the MOV index, which tracks the implied volatility of U.S. Treasury options. It measures the level of panic in the sovereign bond market.
Historically, these two indices track relatively closely. When macro conditions deteriorate, both stock and bond investors seek protection, and both indices rise.
But this week, the correlation completely broke down.
Completely.
By Friday's close, despite the Wednesday sell-off, despite the hawkish Fed, and despite the geopolitical chaos, the VIX actually plummeted 14.35%, settling at a highly complacent 15.99.
Meaning that stock investors, emboldened by tech earnings and Citadel's intervention, completely dropped their defensive postures.
They are actively shorting volatility, selling insurance premium, and signaling absolute confidence that the S&P 500's upward momentum is impervious to macro gravity.
But the bond investors are operating in a different reality entirely. The OVIDV index surged 7.52%, hitting 83.02.
Bond managers are not looking at Microsoft's cloud revenue. They're staring directly at the Fed's policy trap, the sticky 3.3% inflation, and the ballooning U.S. fiscal deficit.
And this fear is physically manifesting in the shape of the yield curve. We saw the 10-2 Treasury yield spread steepen aggressively, widening by 40.56 basis points.
Let's unpack the mechanics of that steepening. When the yield curve steepens in this specific manner, what is known as a bear steepener, it means that the yield on the 10-year Treasury bond is rising significantly faster than the yield on the 2-year Treasury note.
Bond investors are demanding a massively higher term premium to lend money to the U.S. government for a decade.
They're essentially saying, we don't trust that inflation is conquered, we don't trust that the Treasury can manage the fiscal deficit, and we demand higher compensation for taking on long-duration risk.
And when you combine surging long-term bond yields with a complacent rallying stock market, you create a dangerously fragile valuation environment.
Right. Our underlying market data shows the Shiller price-to-earnings ratio, the KP ratio, expanded above 40 this week.
The Shiller PE averages out corporate earnings over 10 years to smooth out business cycle fluctuations, providing a historically accurate gauge of true market valuations.
And a reading above 40 is exceptionally rare. It has only occurred a handful of times in modern financial history, most notably right before the 1929 crash and the 2000 dot-com bust.
It means that relative to the actual cash flows corporations are generating, stocks are historically violently expensive.
Which brings us to the mathematical concept of the equity risk premium. As an investor, you demand a premium and extra rate of return for taking on the inherent risk of buying equities instead of holding risk-free government bonds.
But with the 10-year Treasury yield surging to 4.745% and the S&P 500 trading at a Shiller PE above 40, the math breaks down.
The earnings yield of the stock market is barely higher than the risk-free yield of a Treasury bond. The equity risk premium has compressed to near zero.
You are taking on all the catastrophic downside risk of the stock market, but you are not being mathematically compensated for it compared to just locking your money in guaranteed government debt.
The VIX and the MOVI index cannot diverge forever. Eventually, one of these markets, the euphoric equity market or the terrified bond market, is going to force a violent repricing in the other.
Which perfectly sets the stage for the gauntlet of macro and corporate data arriving next week. The market is not going to have time to rest.
No, when trading opens on Monday, August 3rd, institutional desks are immediately going to start positioning for the most critical data release of the quarter.
Friday, August 7th brings the U.S. Department of Labor's July non-farm payrolls report and the official unemployment rate.
And the stakes could not be higher. Wall Street consensus is currently projecting the creation of 88,000 new jobs, with the unemployment rate holding steady at 4.2%.
And this is where the Fed's dual mandate price stability and maximum employment comes under intense scrutiny. The Fed is desperately hoping for this specific 88,000 number.
It represents the ultimate Goldilocks scenario, right?
Exactly, because if the data misses the consensus in either direction, it creates massive policy headaches. Let's say the report comes in hot, say 160,000 jobs created.
The equity markets might initially cheer the economic resilience, but the bond market will instantly sell off.
Right. A hot labor market implies that wage inflation will remain structurally elevated, virtually guaranteeing that the Fed will not cut rates at their September meeting.
The higher for longer reality will be locked in.
Conversely, if the labor market cracks, if the report shows only 20,000 jobs created, or an outright contraction, it activates the SAM rule.
It signals to the market that the 1.5% GDP growth we saw in Q2 wasn't just a soft patch, but the beginning of a rapid descent into a recession.
In that scenario, the Fed's 3.75% rate becomes deeply restrictive, and the market will price in an emergency rate cut cycle to prevent a massive spike in unemployment.
They are attempting to thread a microscopic needle. But the labor data won't be the only catalyst next week, right?
No, we have a massive slate of corporate earnings that are going to test the fundamental thesis of every major sector. We begin with the infrastructure of the future, Palantir and SpaceX.
Palantir's earnings call will provide the definitive read on commercial AI adoption in the United States. We know tech companies are building the infrastructure, but Palantir's ontology software deployment will tell us if legacy corporations are actually capable of integrating AI to drive efficiency.
And while SpaceX is technically a private entity, their capital markets updates and valuation metrics are closely monitored. It provides the benchmark for the commercial space infrastructure sector,
Which is rapidly evolving into a massive capital expenditure cycle of its own, intertwined with satellite communications and defense logistics.
moving to the hardware bottleneck. The entire semiconductor industry is laser-focused on AMD's earnings.
NVIDIA has completely dominated the AI GPU narrative, but AMD's MI300X chip architecture is the primary challenger.
AMD's forward guidance and gross margin trajectory will reveal whether the AI hardware market is expanding into a healthy ecosystem or if it remains a single-company monopoly.
And finally, we get the ultimate truth serum for the domestic consumer. McDonald's and eBay both report next week. These aren't AI hype plays. These are the foundational barometers of the middle and lower income classes.
They will provide the hard data behind the Conference Board's dropping consumer confidence index. McDonald's earnings will reveal the precise elasticity of demand in the fast food sector.
Are consumers finally balking at cumulative menu price increases? Are we seeing a structural trade-down effect where lower-income families are abandoning restaurant spending entirely?
And eBay will provide a pure, unfiltered look at secondary market e-commerce demand. When the 3.3% inflation squeeze gets too tight, do consumers aggressively migrate to refurbished goods to preserve purchasing power?
Those two earnings reports will tell us exactly how much damage the Fed's 3.75% interest rate has actually inflicted on the real economy.
It's going to be a revealing week.
So as we wrap up this deep dive, let's step back and look at the absolute high-wire act we just analyzed. The U.S. equity market is currently being suspended by the sheer, unadulterated gravitational pull of mega-cap AI cash flows.
Microsoft and Amazon are carrying the major indices on their backs, creating an illusion of broader market health.
It is an incredibly top-heavy market structure operating in a deeply precarious macroeconomic environment.
Beneath the surface of the S&P 500, the Russell 2000 is suffocating under a wall of floating rate debt.
The domestic consumer is exhibiting severe signs of exhaustion, and the sovereign bond market is violently screaming that structural inflation and geopolitical instability are far from resolved.
Exactly.
Which leaves me with a final provocative thought for you to mull over as you analyze your own portfolio positioning this weekend. We began this deep dive talking about a massive multi-billion-dollar hedge fund margin call.
Right.
The Shiller PE valuation ratio is sitting above 40, a level historically associated with massive speculative peaks. The equity risk premium is virtually non-existent.
And the entire public market was essentially saved from a catastrophic contagion event on Friday, not by a natural economic stabilization, but by a private off-exchange intervention by Citadel.
And the structural integrity of the public markets relies on shadow banking bailouts to prevent forced liquidations. The margin of safety is razor thin.
Without a doubt.
So the question you have to ask yourself is this. Are everyday retail investors essentially dancing on a tightrope without a net right now?
Because if the September Federal Reserve meeting doesn't deliver the macro relief the market is desperately pricing in, or if next quarter's AI earnings miss the mark by even a fraction.
Who is going to be left holding the bag when there isn't a white knight waiting in a dark pool to buy the dip? Keep questioning the consensus, everyone.
Good luck out there.
If you enjoyed Wall Street Weekly's market analysis, subscribe and leave a comment or a review wherever you listen to your podcasts, and follow us, Wall Street Weekly, on YouTube so you never miss a market update. We will be back next week with more weekly insights and analysis from Wall Street. Thank you for listening.